Hey everybody, Russell Gray, co-host of the Real Estate Guys radio show, here with another edition of Boots on the Ground. And today we're talking about precious metals, which has been a hot topic. We did our silver series, and the man who helped do that, in fact, he was the brains behind it, is riding shotgun with us for our Boots on the Ground update today, Dana Samuelson. Hey, Dana.
Hi, Russ. How are you today?
Good, as usual. Excited to talk with you. You're such an A student, so as we get ready to do this, you send me all these charts and graphs to look at, and then before the mics go on, we have these epic conversations like, whoa, stop! We need to get the microphones going because people are going to want to hear this. So here we are in September of 2020. And we had the big run up, right? Silver, number one performing asset year to date. Gold punching through the 1923 resistance level that it had been at since, forever, like 8 years or whatever it was, 7 years, shooting all the way up, overshooting to nearly 2100, like 2080. And it's just been kind of channeling in that 1925 to 1975 range. So from your perspective, what's going on? Where do we go from here?
Well, we've stabilized. The metals have been quiet for the last couple of weeks, which is not unusual after a big run. When the momentum changes, we went from a rip-roaring bull market into a corrective phase. I think we're still in a bull market. It's just, as we talked about in our last talk, consolidation phase that we're in. Nothing has really happened over the last couple of weeks to move the markets materially. The stock market's been a bit stronger. The dollar's been relatively stable. The jobs numbers have been improving a bit. So economically, things are looking pretty stable right now compared to where they've been. And we haven't had the Fed drop any new shoes into the marketplace. They announced a couple weeks ago that they were going to keep interest rates low for a long time at zero, and they would let inflation run hot. Gold and silver both perked up on that revelation about 2 weeks ago, but they've corrected back down again. So we're range bound right now, but we're still waiting for another stimulus phase from the government, which we were talking about a bit off camera, which we know is coming one way or the other, which will just increase our debt. There'll be more money printing. So ultimately, I think gold and silver will continue to move higher. So this quieter phase is a good opportunity to add to your positions if you're inclined to do so.
Yeah, I think, for everybody, Dana is talking about looking at gold and silver in terms of their dollar value, and you kind of denominate value in dollars, and you view bull market based on the price of the metals going up, denominated in dollars. I don't look at it that way because I consider gold to be money. And so it's really what I see as a bear market for the dollar right now and taking a time out. And then when you look at the Fed's behavior towards printing and really what Peter Schiff calls the monetary roach motel. And the idea that when Chairman Powell came out and said, hey, we're not only going to not raise interest rates for the foreseeable future, but we're going to let inflation run hot. To say you're not going to raise interest rates when you're going to let inflation run hot, just think about this as a income investor. If I'm going to go buy a savings account, and I know that inflation, the Fed's told me inflation is going to run more than 2%. And the bank is offering me 1%. How interested am I in that 1%? Right? I'm not, because that's really an effective negative yield.
Right.
And so I'm going to demand a higher rate or I'm not going to put money in. And so my bid on that goes away. That's the way the bond market works. My bid on the bonds is going to go away because I don't want to bid on those bonds. China's selling bonds, right? The only people buying bonds are the Fed or people who are trying to front run the Fed. It means the Fed has to print dollars. And the reason we talk so much about precious metals on a real estate show is because when you understand that the future dollars are almost certainly going to be worth less than the present dollars, you want to borrow as many present dollars as you can and spend them today on things that are real, like precious metals and real estate. But where do you get the debt? Well, that's where the real estate factors in. So, I mean, I don't want to digress because we're going to do a whole series, a precious equity series on that, which we're working on. But I just think that it's important for people to understand that we watch the precious metals to give us an indication of the direction of the dollar and interest rates. And right now, what I'm hearing you say with this consolidation is the market is kind of like waiting to see which way it's going to break. Is that kind of a fair statement?
Yes, we're waiting for either economic news or financial news to drive stock market a different way, gold prices, silver prices a different way, inflation, what's going to affect inflation. You know, the oil price was falling, it's been rising again. So, things have been a bit confused because we've never been in this situation before regarding a virus, a pandemic. It's been 100 years since we had a pandemic, and there were no modern communications back then like we have today where we can respond instantly. So market's waiting for something to signal that direction is changing. But your fundamental point of the dollar losing value over time holds true. And gold and silver are inversely correlated to the dollar, which is a way to look at it is to, it's a way to put money into a different, we won't call it a currency because gold and silver are money, right?
Yeah, they don't function as currency anymore because you have to convert them into currency to spend them. They're like a great home base because you can park whatever wealth you have in it and then pivot into any currency because there's always a bid on gold and silver,
right.
Especially gold because every central bank holds it and will bid their currency to obtain it. So, we look at the price and the price is one indication. Before we get into the gold to silver ratio, because I want to talk about that, and you provided a nifty chart that we're going to share, which is super cool. But let's talk about premiums. Premiums is another way to kind of get a feel, at least on the supply and demand side, right? So prices in a free marketplace, and again, you could make the argument that this is not necessarily completely free, but what market is these days, right? So to the extent that it's free based on supply and demand, when there's more demand than there is supply, premiums price go up. Conversely, when the supply kind of catches up, then the premiums and the pricing sometimes comes down. And so we've talked a little bit about price, but what's happening with premiums right now?
Well, we have seen a slower business volume across the industry over the last couple of weeks because we've been in more of a period of stasis than not. So the ability of the mints to produce more than the public is buying has occurred. So premiums are actually dropping. So we're seeing where there were some slower delivery times, a week or two out, the coins are live again. Premiums are dropped. We've dropped our premium on Silver Eagles another 50 cents 2 days ago. We actually have the lowest price of Silver Eagles among our big competitors on the internet right now by $1 or more an ounce, which is unusual. And we're seeing premiums on other secondary items like maple leaves, South African Krugerrands, Austrian Philharmonics drop a little bit, a quarter or 50 cents. So we're still not back to where we were before the whole demand surge blossomed in March, but premiums are getting closer to normal. In gold, we're almost back to normal. So there's been plenty of gold available if you want to buy ounces of gold. Silver premiums are returning closer to normal, not quite there yet, but the abundance of it has been increasing.
Yeah, so there's an ebb and flow. And sometimes you can catch what I call a production lag or a gap where, maybe you get a big surge in demand and then premiums and prices spike and there's shortages and stuff's hard to get. But as long as the underlying material is available, at some point manufacturing catches back up. And some of the manufacturing came offline. Some of the supply chain came offline because of COVID-19. And as that opens back up, then supply begins to step up. There are going to be people that panic bought and paid the high premiums. And I think in the overall, 10 years from now, you're going to forget what the premium was. It's not even going to matter, right? So if you're thinking about it that way, but anyway, but there's opportunities then when that supply overshoots for a little bit and the price begins to stabilize. I think then that's like, okay, now it might be a good time if you're not fully invested, whatever portion of your portfolio you want to have in metals. And there's all kinds of different theories about what that should be. Maybe we'll cover that in precious equity. I don't want to go into it today, but whatever it is you've allocated towards this, it's a good time to add, to your point earlier, add to your position. So what I hear you saying is the premiums have come down,
Mhm.
and it could be a good time. If you had to predict, and I know you can't, but if you had to predict, a week from now, 2 weeks from now, do you feel like the premiums are going to continue to come down a little bit, or do you think that it's kind of stabilized, or do you think they might tend to trend up again?
Well, if we stay in this same kind of business pattern we've been in, which is a quieter phase, there is room for silver premiums to drop a little bit more. Another
Okay.
25 cents or 50 cents on the secondary items, and probably another dollar on silver. Well, maybe 75 cents on silver eagles. They won't get much cheaper than that from where we are now. But we're also going into the latter part of the year, and we're going to have a bit of an interruption because mints don't want to be caught with coins on the shelf dated 2020 when 2021 comes around. So typically, every mint stops minting the current year and shuts down for a couple of weeks and then starts ramping up the next year's dated production. And we're getting closer to that happening. If we get another run in the middle of that switchover, it'll just be another supply shortage. I'm not saying that's going to happen, but it's just we're in a weird
It pretty
phase.
much always does.
Yeah, we have a couple of weeks where things get a little squirrely that way, and we're heading into that time of year where it could happen. Plus, we haven't talked about the fact that we're in an election cycle, and a lot of things can get a little bit more volatile as we get closer to November 3rd.
Yeah, well, I mean, as we're sitting here recording, we know that the stock market, just kind of puked a little bit, and that there's a lot of uncertainty. I think, we were talking off mic, and maybe now would be a good time to talk about it. But you're watching the jobs report, and you have some concerns about that. So why don't you relate what you shared with me earlier? I think that's good stuff.
Well, I think the biggest fundamental indicator of how well or how poorly the U.S. economy is doing is how many jobs we're either making or losing. That's number one. That's the fundamental pillar that things go up above or fall from. And I think we're going into a phase where job losses are going to start edging higher. The stimulus checks have run out for the time being. We're not in a V-shaped recovery. A lot of businesses have been waiting to see what happens before they, let people go. Airlines are talking about losing their stimulus money and big layoffs in the airline industry in particular. And I think that we're in a phase where if things start to get weaker and materially weaker, it could start to turn into a vicious cycle where job losses start to create income losses for people that are more than they can bear. Rents may not get paid properly or in time, and things start to spiral downward. I think we're close to the edge of that. Whether that materializes or not, we'll see. But I'm not encouraged by what I'm seeing as far as job creations versus job losses. It's a lot of small businesses are not going to come back the way they were. And I went out to a restaurant for the first time in months last night, and the restaurant, more than half the tables were blocked off with a sign that says, for your protection for social distancing. And it's an eye opener when you do see that, because how can they operate in any kind of a really profitable capacity when they can only have half or less than half of their customers inside?
All right, so we had a little bit of a technical snafu there, so sorry for the break, but we were talking a little bit about restaurants and the restaurants not being able to make it. And, the real dichotomy, if you will, between the big businesses that have access to capital and lending and the equity markets and the small guys that are just struggling and fighting for their lives. And of course, if you believe the statistics, people say that 70% of the economy and jobs come from small businesses. I think that the powers that be are aware of that. Obviously, that's what the PPP loan program and stuff, and a lot of the big companies that tried to take advantage of that got publicly shamed. And then, recently there's just all kinds of people that made up fake companies to steal money, and they're being prosecuted. So it was a great idea on paper. Of course, in the real world, human beings, with nefarious motivations somehow find a way to screw up something. But to your point, Dana, we're in an election year. And we're at a point as real estate investors, we're paying attention to this because you've got, the CDC coming out with the eviction moratoriums. But here's my take on it and why I'm not overly concerned about it. My big concern still remains the Fed. And let me just share this with you and tell me what you think. I feel like the Fed found out that in 2008, that if they allowed debt to go bad, it is a very expensive cleanup job because they have to eat hundreds of billions, if not trillions of dollars of toxic assets at face value in order to save balance sheets. They have to print a ton of money to do it. And they went from 800 billion to 4.5 trillion to do that.
That's correct. Yeah, that's exactly right.
So this time, I think they're older and wiser, and they realize that if we just feed the economy enough money to make the payments, it's a lot less. So we have to find ways to get money directly to people, PPP loans, direct injections, rebates, anything at all. And I think that they're dedicated to doing that. And I think that at the end of the day, that tells me, and again, that may not be true, but both roads lead to the same place. And if we do have an economy that does not recover in terms of creating real jobs where people can make real incomes and pay their bills, then somehow, some way, that is all going to have to get papered over. And that means printing of dollars. And when you dilute something by increasing the supply, then its value falls, supply and demand. And that's where we have what's called inflation. Doesn't mean prices go up. It just means the value of the dollar goes down. Now you say, well, those two should be correlated. They should be, but they're not always because we spend money outside of our little system. It goes overseas. There's just things that happen. But that's why we watch the precious metals price. So let me ask you this, Dana, based on that and your concerns about employment, how do you see that affecting the prices of the metals denominated in dollars?
Well, gold and silver are typically inversely correlated to the dollar. So if the dollar weakens, gold and silver will go higher relative, which is why it's good to have some as a way to de-dollarize, number one. And I do think if the economy weakens, you're right, the Fed, it's easier for them to make the interest payments than the principal payments, basically. And they are doing that. That's what they're doing. It just means greater debt for us, which is not good for our balance sheet, and it's ultimately not good for the dollar either. So they're kind of stuck between a rock and a hard place where if they don't, it'll be a lot worse. And if they do, it's still not going to be good.
That's the monetary Roach Motel that Peter's been talking about. And the third part of that equation is interest rates. Because if interest rates go up, bond values collapse, and they can't allow that to happen because then they have to suck up those toxic assets. So at the end of the day, and the reason I put so much emphasis personally and in the show and the real estate guys on getting people educated about precious metals is there's a ton of pressure on the dollar right now, so much more than I think people realize. And right. If you are not preparing for the contingency, I'm not saying it's going to happen, but I don't think in my lifetime, maybe even since Nixon broke Bretton Woods in 1971, and I was only 11 years old when that happened, but I've never seen so much pressure on the dollar. And if you're an investor out there and your whole world is the dollar, you earn dollars, you borrow in dollars, you're obligated in dollars, you save dollars, all your assets are denominated in dollars, and all of your thinking is in dollars, and you're not prepared for the dollar to break, I think you're skating on thin ice.
Right. And ice is actually a good metaphor because it's like holding an ice cube in the summertime. It's just going to melt and melt. And sooner or later, you're going to have less and less of it until it goes away. Now, it's not going to go all the way away, but we're in that kind of a situation where the dollar is really poised to decline in value relative to other currencies, especially if we stay in a viral mode like we've been in and other countries come out of it. But we're going into the fall again now. Whether it's getting colder, whether we get a second wave or not, who knows? There's a lot of wild cards right now, more than we've ever seen probably.
Well, let's do gold silver ratio real quick because we don't want to wax on too long. I mean, you and I could just go on and on and on. It's so fun. Let's see if I can figure out how to share this chart. There it is, right there. Okay, so this is the gold silver ratio chart Uh, let's see, move this out of the way. And from January 9th, 1995 to September 9th, 2020. And so, Dana, I have the cursor, so I'll kind of navigate around, but I'm going to let you narrate a little bit. All right. So I'll kind of feed you. But
Okay.
what we've got is we've got these three lines here. And first of all, just, and I know this is a boots on the ground and not a tutorial, but I want to make sure anybody watching it who hasn't seen the silver series where we talked about gold silver ratio, just give us a nickel tour on what the gold to silver ratio is.
Well, it's simply a relative value measurement of how many ounces of silver it takes to equal an ounce of gold by dividing the gold price by the silver price. And what the chart really shows is the top red line and the bottom green line are the big uh, ranges for when gold is strong relative to silver or silver strong relative to gold. When the number is low, silver is stronger relative to gold. And when the number is high, gold is stronger relative to silver. And the equilibrium point's about 62, 63 to 1. An extreme high is at 82 to 1, and an extreme low is at 48 to 1. Today, the range is right at about 72 to 1, so it's a little on the high side, which means gold is still favored a bit, but it's much more in parity than it's been over the last 6 months, as you can see that abnormal spike. I mean, when I used to do this chart as late as February of this year, the whole chart was filled up with what was between the red and the green line. Now
Yeah.
that big spike has taken up half of the width of the height of the chart. So it's what it's telling you is that gold was leading, and now silver has played catch up in a big way. With the gold price today at about 1940, 1950, and actually a little higher, 1960, and silver a little over $27.
So people who use this, at least the way I use it, is to decide if I'm going to make an allocation of converting dollars into precious metals, what's the better buy at the time?
Exactly.
And the way I had to learn to think about it, and hopefully this will be useful to somebody out there, so I don't want to drag on, but I think it's an important point because it took me a long time to get my mind around it. If you think of silver as dollars and you want to know how expensive gold is, right? Then
Yep.
you think, oh, over here, gold cost $125. Right now, it's only $69.
Right.
So it's cheaper to spend your silver or sell your silver to buy gold compared to here,
Right.
right?
Yep.
So if you think of it that way, it makes it a little bit easier to understand. Here, I feel like at this range, you could buy silver or gold, and it's kind of like a toss up in my mind.
Right.
And then if the tiebreaker for me would be, well, if I don't have any gold yet, I probably want to have gold because gold is the thing that central banks buy. Gold is the thing that's really the main money. But silver can offer a great opportunity to have a precious metals exposure, especially when you see something like up here. When it's way up here in Nosebleed City, they're like, that's cheap. And so you could even consider, hey, I'm going to sell some gold and buy a bunch of silver. And then when it comes back down, I'll sell some of that silver and buy some more gold. And people who are active, and of course, you got the friction of the trade, so you don't necessarily want to do that. But that's kind of the way the gold silver ratio works. Is there anything, Dana, you want to add to that or you want to point out about this chart that you think is notable?
Well, the way I look at it is if someone is a new buyer and they come to me and they say, I want to spend $10,000 or I want to spend $100,000, what do you recommend? Well, I fundamentally would recommend both gold and silver, but depending on where the gold to silver ratio is and whether it's strong or weak, I would recommend a disproportionate amount of whatever is weaker. So when the ratio is over 85 to 1, I would say if you want to spend 100,000 right now, spend 60 or 70% of that on silver and 30 or 40% on gold with it back below the top line, but still above the median line. To me, that's a 50-50 proposition. If the gold silver price plays catch up further, which it still can, because remember, and we haven't talked about this, gold is already at a record high in dollars, but it's still about half of its previous high in silver.
Yeah.
So silver potentially still has room to run further without breaking a new price record. It could almost double from here and still just challenge its previous high. So I might still weigh a little bit more heavily in favor of silver, 55-45, but that's how we use the ratio. And if it always tends to come back into parity, and 3 months ago, who would have thought it'd be back to 72 today,
Well,
right?
I mean, but I think anybody who saw 125 who understood this recognized that was the time to back up the truck and buy a bunch of silver, because the only question you had to ask yourself at that point of time is gold way underpriced, or is still, I mean, I've got it backwards.
Right.
Do you know what I'm trying to say, Dana? I mean, I've got it
Is,
backwards.
is gold way overpriced or is silver way underpriced at that point?
Yeah. And
Right.
so the question, the answer in my mind there was, okay, well, gold was pushing near a high. It wasn't over the all-time high yet, but it was like within $100. It was like 1,700, $1,800. And silver was way down at like what, 11 or 12.
1185. Yeah.
Yeah. And it's like, okay, I think that's a no. Oh yeah, it's right here. Duh.
Well, that's when we had the big knee jerk sell off. So that's an abnormal, that was lasted about a week.
But the point is, Dana, that anybody who was following the gold silver ratio recognized this was a unique opportunity and was loading up at 1185, because having it crash from there is a positive from the price, because the price, when it went from 125 down to 75 or whatever it was, that meant this price doubled, or more than
More
doubled.
than a double, yeah. And that's exactly what led to those silver shortages. It's silver shortages that we've had ever since. Was a big backing up of the truck, people buying silver when it crashed.
Yeah.
And
So
we're still coming out of that phase.
yeah.
6 months.
So we'll look at this. We won't look at this every time we do boots on the ground because it's a little bit granular. But Dana, I think you have this. Don't you have this on your website? The gold silver
Yes.
ratio. Yeah.
Yes, it's right on our homepage. There's the gold to silver ratio,
Yeah.
and gold to platinum and palladium ratios too, as well.
Okay, so we'll put the link to Dana's website down below, and a link to Dana's report on precious metals. If this is your first time and you kind of want to learn how to buy physical precious metals, you ought to check out our silver series that Dana and I did together. I say I was the co-host, or the host, I don't know what it was, but we both had a lot to say, and it was a ton of fun, and we learned a lot. I learned a lot. And here, I think, though, that we'll look at this from time to time, but if you're not familiar, if you're interested in precious metals, you should be watching the gold-silver ratio and just keep watching it. And pretty soon it'll start to make sense to you. And then you'll recognize when there's a big opportunity. And, a lot of silver investors saw this 125 and saw, wow, that is a huge opportunity. And those that got on board with it did really, really well. And right. I think anybody that saw, that's why we decided to do the silver series. I saw that and I said, oh man, silver's going to be fantastic. Let's do the silver series because that's going to be a hot topic. And that's exactly what turned out to happen.
Right.
Okay. Well, I apologize for the technical difficulties. Hopefully the finished product comes out well. We'll try and get that sorted out before we do this again next time. But Dana, any closing thoughts for anybody on what's going on in the wide, wonderful world of precious metals in September of 2020?
Well, it's like I said, we're in a quieter phase, but these things don't always last. And I think we could get into some real volatility as we get closer to the election, and especially if we see jobs start to really roll back over and start to head back down again. Stock market's shown some real vulnerability over the last 3 or 4 trading sessions, and we've tended to be inversely correlated to the stock market as far as demand goes. When the stock market's doing well, our phones get quiet, but when the stock market falls, our phones light up. So our whole industry is going through a quieter phase, and premiums are getting closer to normal. It's a good buying opportunity from a price point and from a premium point. We get back into another demand surge, the opportunity won't be quite as good as it is right now. So I like to buy these quieter periods because it tends to be where the value is, but most people are driven by fear, and there's no fear when things are quieter like they are right now. So it's a bit contradictory to the human psyche, which is what you have to try and overcome as part of, you understand that as an investor,
Well, absolutely. I mean, that's why we study, because we want to be able to recognize opportunities other people don't. We want to be able to buy when others are selling, or what Warren Buffett says, we want to be greedy when others are fearful and fearful when others are greedy. Right. This is a time, where maybe people are going elsewhere. But if you look at the big macro trend, I mean, no matter how you slice it, the Fed is going to have to print a lot of dollars. There's just no way around it. There's bad debt out there. There's the unemployment issues going on. There's the dramatic need to keep interest rates down at all costs. All three of those things say print more money, print more money, print more money. And they're not even trying to pretend that they're trying to normalize their balance sheets or they're going to normalize interest rates. They've given up even the pretense of that. So that is all, from a dollar perspective, bullish for precious metals. And so when you get a quiet period when those premiums come down because people who don't understand what's going on are running back into the stock market or hiding wherever, if you understand what's going on, it's an opportunity for you to kind of build your long-term position and get a good value. If you don't have any and stuff starts to break, then I think, you do what you need to do in whatever market, but take advantage of these opportunities, I think, is the lesson for September 2020. Okay, sir. Well, I appreciate you sharing your expertise with us again, and look forward to doing it again very, very soon.
Thank you, Russ. It's always a pleasure to talk with you. I appreciate it.
Thanks, Dana. Take care.